Hello, everybody. This is Ed Yardeni. Nice to join you all. Hope you all had a good January. January. I'm still thinking January. I don't know why. Hope you all had a great July 4th weekend. I guess the way things are going, time flies. It's already July, and before you know it, it'll be August, and then down the road it'll be January's. But I guess I'm thinking about January because I'm thinking ahead, and the market thinks ahead. The market is increasingly starting to discount 2026 earnings expectations, and the analysts have stopped cutting their earnings expectations for 2026. They are now expecting earnings to be $300 a share next year, which just happens to be my forecast for next year. I think it'll be $300 a share for the S&P 500. For this year, the analysts have also stopped cutting their estimates in recent weeks, and they're down to $263 a share, which is pretty close to where we are. We're at $260 a share. So we're consistent with the analysts' expectations. I have to say the analysts do tend to be too optimistic. The more time there is between their estimate and the final results. So maybe we're too optimistic, and maybe these numbers are too high, but they certainly do not anticipate a recession. There was a lot of that concern only a few weeks ago on April 2nd with the Liberation Day reciprocal tariffs, then the postponement of those tariffs. But I'd say April, May, there was still a lot of concerns about a recession. We saw that in the poly markets data that's available from that trading platform. I think it got up to something like 60% was the probability of a recession this year only a few weeks ago. Now it's down to about 20%. So those anticipations have changed a lot. And again, we're seeing it in the analysts' forecasts. They've stopped lowering their numbers, and they've flattened them out at levels that are still pretty good and certainly do not signal that they're worrying about a recession. Now, I've said this many times before, analysts are not particularly good at giving us an indication of a recession coming. They typically wait until the companies that they follow tell them that we're in a recession. So if you agree with me that there's no recession for the rest of the year, probably not a recession in 2026, maybe not a recession for the rest of the decade, maybe. That's my most likely scenario, but clearly I wouldn't rule out a recession. But the markets and the analyst expectations certainly suggest that after the recession scare we had that caused the bear market in 2022, from January to October of 2022, we had a significant correction. Actually, it was a garden variety correction, about down 25%, lasted, about 9 months, 10 months. No big deal with the benefit of hindsight. Of course, in the thick of it, it was quite a downdraft, particularly in some of the cyclicals like technology. But we hung in there. We argued that the most widely anticipated recession of all times was not going to happen. Well, what it did happen is we did have another sort of widely anticipated recession this year. And again, we stuck to our guns. We said that the economy proved resilient in the face of a tightening of monetary policy in 2022, 23, 24. Monetary policy was on the tight side. We think now it's kind of where it should be. The unemployment rate actually ticked down to 4.1%. That's full employment. The inflation rate, if you go to the Cleveland Fed's inflation nowcasting, it's mind-boggling. They're looking for a July number for the CPI for the headline of plus 0.07%. Now, of course, it's early in July, and we'll see how their numbers pan out as the month progresses. But for June, I think their number was something like zero. It's basically 0.2%. It's a very, very, very small number. So there's no sign really that the tariffs that Trump has imposed on steel, aluminum, copper. I think he's put it on copper, but steel, aluminum for sure. On autos, I've actually been looking for for a new car, and I don't know whether to buy used or new, but I think I'll treat myself to a new car, appreciating the fact that depreciation in the first year is no fun. But I've been looking at list prices, anyways, and you can still get cars for $27,000, kind of stripped down with all the doodads. But if you want all the safety features and feel like you got it all, before you know it, you're looking at something like 35 to 40,000, and then some. If you're looking for something a little bit uh, sleeker, more luxurious, I looked at Lexus. Their numbers are already like. And by the way, it's always were Toyota Camrys and Rav4s. I was looking at the Lexus, and I couldn't quite believe what I was seeing. But the number, maybe these are pre-tariff numbers, and I didn't realize how expensive Lexus are. But I think the numbers were like $60,000, $70,000. So cars aren't cheap, and maybe they're about to get more expensive as we get through the summer and the tariffs start to hit on the automobiles. But right now, we just really haven't had much in the way of an inflation, any showing of inflation from the tariffs. We haven't really had any showing of large unemployment from the Doge Boys activities earlier this year. We're not seeing really anything in layoffs. Initial claims remain extremely low. The unemployment rate remains low. There's a series that we track, which is the unemployment rate for people who are unemployed and couldn't find a job the following month. So they were unemployed, and it's hard getting a job, so they remain unemployed. And if that goes up, that says the duration of unemployment is increasing. It actually went down in June, so that suggests that some of these indicators of longer duration, like continuing claims, uh, may not be all that accurate. I think it is taking longer to get a job when I look at all the data that's relevant. But on the other hand, the labor market seems like it's in pretty good stead. So we're basically where we should be when it comes to the dual mandate. Inflation is close to 2%, not quite there. Under the circumstances, we're awfully close. I mean, if you take the CPI and take rent out of it, we know rent inflation is still coming down. It's just a slow poke. But take that out, and we have under 2% for the CPI headline and core. So I think we're basically in nirvana. And if that's the case, then the Fed funds rate is where it should be. So I fundamentally disagree with the message of the Fed, sort of fundamentally disagree. What they've been saying is they are in no rush to lower interest rates. If it was up to me and I was being data dependent, looking at the same data as they are, I would just leave it as we're in no rush to do anything with interest rates. We'll have to see how the data plays out. We're not biased one way or the other. Here, they're basically saying that they believe that the Fed funds rate is still restrictive, that it needs to be lowered, but they're in no rush to lower it because in the interim, they've got this question about the inflationary short-term impact of tariffs. And of course, Trump keeps beating up on Powell almost daily now. I think part of that daily drumbeat isn't because he expects that Powell will cave in or the FOMC will cave in. I think a lot of it is actually aimed at weakening the dollar. It certainly seems to be working. And I think the administration is sort of conflicted. Scott Bessent has sent messages out in the past where he said that he's the dollar should, no one should question the viability of the dollar as the key currency in the world. And yet at the same time, he and Trump has made it clear that they wouldn't mind a weaker dollar, seeing a weaker dollar. So beating up on Powell and indicating that the Fed is not going to be politically independent once Powell is gone as Fed chair. That may be weighing on the dollar. I know everybody's bearish on the dollar. Maybe my contrarian instincts are coming out too much here, but I'm not really bearish on the dollar. I think it's kind of sold off in a fairly normal kind of sell-off, kind of near the bottom of a range. So if it sells off anymore, it'll certainly maybe get me to put up the white flag and conclude I've been wrong. But there's still, I think, money coming into our capital markets, stock market, bond markets. I think foreigners haven't given up on the U.S. dollar, and it's pretty hard for them to do that, given how big the U.S. capital markets are in the global economy. So where do we go from here? Well, the employment numbers were better than expected. I wish I could tell you that they were unbelievable and look how right I've been, but actually they weren't that marvelous. And the excuse I would make for it is they were pretty good under the circumstances, given that all the uncertainty concerns about Trump's policies, particularly with regards to tariffs. It's pretty impressive how well the labor market has held up. With regards to June, yes, payrolls were up 147,000. That's a good number. It's not a blowaway number, but it's I guess it was blowaway relative to expectations. But the work week was actually down a bit, and the average hourly earnings increased by a piddling 0.2%. That's about consistent with what inflation is doing. So real wages barely went up, if at all, during June. But you take those three variables: payroll, employment, the hours worked, average hours worked, and then you put in wages, and you get our earned income proxy, which is a proxy for wages and salaries and personal income in the private sector. And maybe we're up 0.2, 0.3. So it's not great with regards to its implications for retail sales, for example, for personal income. So I think we're still pretty much in what I've described as a soft patch. It's not a recession. I think with the stock market now having a very positive wealth effect, with less concerns that Doge has created all sorts of problems in the labor markets, I really haven't seen much in the way of big cutbacks in employment in the government sector. With all that, I think confidence will come back, and people will do what they've been doing. Consumers will be spending, particularly the baby boomers are sitting at $80 trillion. I know that the pessimists have been pointing out that a lot of student loans now have to be paid, and many are in arrears. Some may be very delinquent and so on, and that burden is going to depress consumer spending. But I think student loans are about $1 trillion. It's a big number. But the net worth of the baby boomers is $80 trillion. So, compare that to compare the two, and I would still bet that the baby boomers keep the economy moving forward, spending on healthcare, on leisure and entertainment, and so on. So I think that the stock market I think it's had an unprecedented recovery here, really been phenomenal. And it hasn't been just tariffs, as I've mentioned before. It's also been the DeepSeek effect, where people got very nervous in late January when DeepSeek announced that they had created a large language model with the cheaper versions of NVIDIA chips, that people started to wonder whether all this spending on high-end NVIDIA chips was really necessary, and whether we were going to have a big glut of data centers. Again, my current contrary instincts are kind of coming out here, and I am kind of wondering whether we are going to wind up having a surplus of data center capacity. I mean, Trump went over to the Middle East and got them to get excited about building data centers. They're building data centers in Asia. There's I guess some concerns about whether we should be selling to Malaysia any NVIDIA chips, because they might be funneling them to China. But clearly there's been a boom in building data centers. And from what I understand, and I'd love for some of you who might have had a closer look at it, I did talk to our good friend Jim Lucier, down at Capital Alpha in Washington, D.C. He's a great Washington watcher. And in the bill is 100% depreciation allowance, which means that if you build a data center this year, you get to depreciate expense the whole thing this year. Please correct me if I'm wrong in the comments, and I'll mention that. But the tax laws just changed pretty dramatically, and certainly with that kind of depreciation allowance, the incentives to go wild, particularly in technology, particularly in data centers, is significant. So this may turn out to be a melt-up, melt-down situation if and when we discover that AI is a wonderful technology, but it's prone to hallucinations. It doesn't do everything that it's promised to do. That it doesn't reason very well. In other words, that it's artificial but not intelligent. It's a probability model, and I use it on a regular basis. I use Grok, and sometimes when Grok looks like it's wrong, and I guess Elon Musk is the owner of Grok, and I have to agree with the President Trump. Elon does seem to have gone off the rails of late, but should stick to his knitting and build cars and robots and spaceships and all that. Now he's starting a party, but anyways, I still use Grok, and I use it as a research assistant. And like all research assistants, some are unbelievably smart, and some aren't, and you never quite know who you got. So you always want to check. So I think you can't just use artificial intelligence and assume that it's intelligent and whatever it gives you is correct. You do, unfortunately, have to spend some time reading its results and then double checking it. And unfortunately, you really kind of have to do the whole thing. So at some point, you ask yourself, so why am I thinking even that artificial intelligence is going to replace my job when it can't do my job without me checking it out? And I know Microsoft is firing a lot of coders and all that, but you never really know what they're doing on the other side, whether they're hiring a lot of other people to double check what the AI software coding is delivering. Anyways, I'm wandering about here. Let me get a little bit more focused here. With regards to the market, starting to feel a little bit like maybe a lot like we're in a melt-up situation again. We were talking a lot about a melt-up before the correction that started at the beginning of the year. And now we're kind of back there, right? I mean, the multiple is back to 21, 22 forward earnings. Technology is hot. Its valuation multiple is high. Of course, earnings have come in much better, especially during the first quarter. They're going to come better than expected in the second quarter because expectations are for a piddling 3% increase on a year-over-year basis. So I'm sure we'll have a earnings beat. I'm sure we'll have an earnings hook, as we like to call it. With regards to the bond market, I think I'm feeling pretty comfortable with our forecast. It's working out 4.5% plus minus 25 basis points through the end of the year. That could be what happens next year, but I don't really know enough to be as strongly committed to that view. But kind of, I don't believe that a credit a debt crisis is right around the corner. I mean, that obviously is one of the few risks that are remaining. The geopolitical risks in the Middle East seem to have simmered down. The tariff issue has simmered, but it hasn't really completely simmered down. It's now we got an August 1 deadline basically for these agreements, so that's still an issue. But the market's kind of learned to live with it and conclude that maybe it's not going to have as big an impact on the economy or on inflation as was feared, and that this too shall pass. The midterms are coming. On the political news, I flip between Fox and CNN to get a balanced view of the world, and they're starting to talk about the midterms. And I think the administration has to get this issue behind them. They've got their big, beautiful bill done. And so now I think they just have to go promote the policies that they've manage to implement and convince people that they've done good for them, and then hold on to their majorities in the midterms. There's a long ways between now and the midterms, and a lot can happen that could benefit the Republicans or hurt them in terms of keeping their majorities. Let me quickly turn to the charts. The morning briefing is devoted to a long discussion of Trump's plan for getting around Powell. And he was interviewed by Maria Bartiromo last Sunday, and it wasn't widely picked up. A few people kind of caught it, but maybe I'm wrong. Maybe everybody knows this, but he said that when Maria asked him about what are you going to do about refinancing $9 trillion of debt up ahead here, he said, it wasn't clear to me whether they're set for this year or up ahead. I'm not quite sure. I mean, we're already halfway through the year, so let's say it's for the next 12 months. Again, correct me if you know the right answer on that. This is an interactive discussion we're having. But the idea is that Trump came up with, and I'm sure Bessent gave it to him. Bessent, as you know, was initially opposed to what Janet Yellen did, and what Janet Yellen did was to issue more Treasury bills. Remember on November 1st, when they issued the quarterly refunding announcement, they announced that they weren't going to increase notes and bonds. Instead, for the increased needs for financing, they were going to do it in bills. And so the bond market rallied significantly on that. And Bessent didn't like that. They thought it was too gimmicky. And of course, now that he's Treasury Secretary, that's exactly the gimmick he's playing. And I think he explained that to Trump. And so Trump now, I think, sees that as a great, that puts the cards in his hands. He likes to play cards. And so the cards now is he doesn't really care about Powell anymore, because what he'll do is he'll finance all of that $9 trillion in T-bills. And then by early next year, one of the Fed governors' term expires. He'll put in a new Fed governor. And then in February, when Powell's term as chair expires, whether he stays on or not as governor will be irrelevant. Trump will elevate his Fed governor, his new Fed governor, to be Fed chair. It could be Christopher Waller, who is the current governor. It could be Scott Bessent. It could be some of the other names that were mentioned. But everybody would view whoever he nominates as Fed chair as kind of corrupted, not independent, a loyalist to Trump. And there may be some pushback from the FOMC committee. I mean, Bessent has pointed out of late, I think he's starting to regret this whole game that he was sort of signing on to. But I think he's kind of regretting the idea that Trump can just put on a loyalist and lower interest rates. He did remind us, quote a couple of days ago, that interest rate decisions are made by a committee, and that you can have one or two dissenters, but you sure wouldn't want the new Fed chair to be one of the few dissenters and the majority to conclude that we're in no rush to lower interest rates. So a lot of interesting games up ahead here. And so, anyways, in Trump's game plan, he finances everything short term that he needs to. Gets Fed chair to his liking. The Fed chair to his liking has the amazing ability to convince the entire committee, with maybe one or two dissenters, to lower interest rates. And then the other key assumption here is lowering the Fed funds rate will lower the bond yield, which, well, hey, not so fast. That might not happen. It didn't happen when the Fed lowered interest rates in late 2023. Let's go have a look here. So here's the bond yield. Here's the Yellen's more bills policy. We got up to 5% here. She announced that they were going to do more bills. The bond yield came tumbling down. Then we'll skip all this and go to Fed cuts the federal funds rate by 50 basis points. And just as they did that, guess what? That started a backup in bond yields. Bessent was nominated, a drop in the bond yield. Oh boy, it's one of us where we got to somebody who understands markets and will do right by us in the financial markets. Well, not so fast. The tariffs kind of got everybody in a tizzy about what it all means. And so we saw bond yields going up. And then the perception was that that's going to cause a recession. So bond yields came down. And then we had Liberation Day, which at first brought bond yields down on perceptions that that was cause a recession. And then the bond yield on capital market turmoil shot up from 4% to 4.5%, got Trump and Bessent attention. That's the Bond Vigilantes. Like, yes, whoever did that got their attention, and that was Liberation Day was postponed. Then we had Moody's downgrade, and of course they downgraded. And what did the bonds do? They found buyers, and here we are at this point where the bond yield went up on Friday. Why? Because of the employment numbers were stronger than expected, and that's where we are. This is the Fed funds rate. They lowered it by 100 basis points. And of course, I think we were among the few that said that bond yields might go up on that, and that's what they did. We didn't understand why that was necessary. I guess around there was some weak data that convinced the Fed they had to lower rates, and they did it by 100. But we didn't agree with that. I guess if you're a Republican, you could argue that the FOMC was favoring Kamala by lowering interest rates, but I wouldn't do that. Let's give them the benefit of the doubt, said they did it as an independent measure. And the bond yield went the other way and said, well, whatever the reason is, we disagree with that move. And then the bond yield's just been fluctuating around the Fed funds rate at this level. So I guess Trump might be right. If they lower the Fed funds rate, the bond yield might come down. But he could also be wrong, depending on how things play out. Best laid plans of mice and men and all that. You can look at the rest of it on your own. There's a lot of charts on debt. Why don't we open it up for some questions? Because as always, I talk too much. Okay, so let's see. Yes, Max decided not to appear today, so we are Maxless today. Let's see what we got here. Let me put it on the other screen. All right. See, if I had Eric here, he'd be reading this to me, and I wouldn't need my other glasses. But Eric is serving our country as assistant to the chair of the Council of Economic Advisors. So he's in a good position. It's going to look good on his resume. We'll see. Maybe he'll come back. Maybe he'll run a hedge fund. I do keep in touch with him on a regular basis, but I obviously don't ask him about policy making, but I do give him my advice every now and then, and he just says, "Uh-huh." Okay, Rich. Rich is kind of a long question, so let me see if I can scan it here. Trump recently indicated he was instructing the team to issue debts with maturity not longer than 9 months until sometime in 2026. I again, that's what the morning briefing is all about. I didn't see that 9 months into 2026, but I'll look for it. I'll ask Grok where that came from, but I didn't see it. Let's put it this way: Grok didn't come up with it when I was using it as a research assistant. So maybe I'll use ChatGPT. If the Treasury does follow through with the instructions in the new QRA quarterly refunding announcement, is it going to be equivalent to Treasury QE? Yeah, that's the point of the piece this morning. Have a look at it if you haven't. It's or maybe I wasn't clear enough, but yeah, I labeled it not as Treasury QE, but as yield curve control YCC-T. In other words, Treasury yield curve control. Let me move on here. I didn't answer all of your question, Rich, but I'll try to get to it in my write-ups. Adam, I had the city panic, euphoria, fear, and greed. AAII and a number of other indicators are in overbought territory. How likely do you view it correction from here? I don't know that AAII or the Investors Intelligence is quite at bullish readings that suggest we're due for a correction. I think we're kind of in the midst of all that, but there are some that are signaling that we're getting a little pricey here. So I'm not going to tell you there's another correction up ahead here, but maybe it's time for a little bit of summer siesta for the market. Michael Brush, the market controls the 10-year rate, not the Fed. True, false? Let me think about that. Yes, well, it depends, right? I mean, when the Fed was doing QE, they pretty much controlled the 10-year. But I'd say now that they're not doing QE, I'd say that the market controls it. By the way, I should have shown you the charts. There's a chart in there that shows the amount of debt outstanding by bills, notes, and bonds. And maybe the reason we're getting we're exaggerating the Bond Vigilantes ID is the amount of Treasury bonds outstanding isn't $27 trillion. I mean, that's the total amount of debt. A lot of that is bills, a lot of that is notes. Treasury bonds are $5 trillion of that. Now, $5 trillion, a trillion here, a trillion there, it's big money, but it's $5 trillion. And there's surely, under any circumstance, I would imagine that there's $5 trillion of demand in the world for US 10-year treasuries. So this idea that suddenly people are going to bail out of 10-year treasuries when there's only 5 trillion of them, and I think the total debt in the world is like $300 trillion. And again, maybe I'm kind of not remembering all the numbers I should be remembering. A lot to remember. I don't know if that 300 trillion is sovereign debt or total debt. I'm under the impression it's total debt. But whatever it is, $5 trillion is pretty piddling when you think about it. So maybe, we're all getting excited about $27 trillion, and that's like 100% of total debt. But a lot of that is bills, and nobody's ever nobody's ever going to wonder whether there's demand for bills. And 2 to 5 year notes, there's always going to be a demand for that. I guess we could push the limit on that, but everybody, has been really focusing on bonds. And I think you should put that in that perspective. I'm almost done. Cagdis, Ed, with many of the things in Trump's agenda behind us regarding tariffs, BBB, Middle East, NATO, what will be the focus from here, and how do you see that from a market perspective? Well, if I was advising Trump, I would tell him, you've done everything you promised. You got that in your big bill. You said you're going to do tariffs. You got to kind of clean that up, wrap that up, get more countries to join the Abraham Accords. Decide what you want to do with Ukraine. Are you for them or against them? Just basically outline everything that you've accomplished, that you promised and you've accomplished, and see if and then campaign. Do your conventions. He loves those rallies that he has. Do that. Go around the country and see if you can hold on to the majority for the Republicans. And don't screw anything up. Don't do anything that'll screw up the midterms. Again, that was if I was advising Trump. I don't think the Democrats would ask me to advise them, so we'll leave it at that. Chip, considering the economy is nirvana, notwithstanding home price affordability for working folks is unaffordable, how do you feel about current rates with this dilemma? Chip, I'm glad you bring it up. I always get myself into trouble by saying everything is wonderful. Everything is not wonderful. There are a lot of people that are suffering. The housing market is not in good shape. Homes cost too much. My younger kids are having troubles making ends meet, which means that I'm helping them make those ends meet. I think a lot of baby boomers are doing that, but not everybody has a family relationship with people that can help like that. So there's certainly people that aren't doing well, but the unemployment rate's 4.1%. That's the important thing to keep in mind. The misery index is extremely low. So again, that's something to keep in mind. Well, since you aren't leaving, there's still nobody has left the webinar. Let me take one more question here. Ed, have you tried Claude from Anthropic? It is powerful as well. Plus, my son just started working there. I'll give it a try. I got 4 or 5 of them, so I'll give it a try. According to a February article by Finbold, $9 trillion matures in calendar 2025 with 70% or 6.5 trillion between January and June. So 3.5 trillion in remainder of 2025. Thanks so much. And that's an article in Finbold. I haven't found a regular source for that, but if anybody knows a regular source, share it with me and I'll share it with the crowd. Gus, Ed, we are seeing a downward move in the pool of unemployed and saw government increase in employment demand, which looks one time. Are you thinking that if employment slows, the rates get cut? I don't know. I mean, the labor market month to month is hard to interpret. There's a lot of data there, and you can come up with just about anything you want to come up with. What I'm coming up with is that the labor market has been hanging in there pretty well for the past few months, given Trump's tariff turmoil. And that's not a opinionated statement. It's just a fact. That's what it's been. And the markets, the economy have held up well. I think I wouldn't be surprised if the labor market shows some strength in the second half of the year. So I'm still in the none and done camp, Gus. I don't think that the Fed will need to or should be lowering interest rates. Gus, one last question. What do you look for when you say we are potentially in a melt up, and are we in one now? Okay, Gus, you made me say we're sort of in a melt up, sort of, kind of, if you allow me to put some adjectives on it. 21, 22 is pretty rich for the multiples. It's back to believing that AI is a miracle technology. I think it's evolutionary, not revolutionary, but that's, the markets are very excited about it. There is a lot of spending going on. The data center stocks have been going through the roof. I mean, just look at the way this correction has been reversed. It's been a melt up recovery for sure. But earnings are good. And so I think I'm kind of hoping that the market will be earnings driven, and maybe we'll get some good surprises in the second quarter that will allow this market to have a little bit more substance in terms of earnings and not be as full of air when it comes to valuation. Well, on that note, let me thank you for joining me. Let's do this again next week, and have a good week. Thank you.